While the public was distracted by the orchestrated chaos of the 2024 and 2025 election cycles and the hyperfixation on speculative AI bubbles, a quiet filing occurred within the Department of Health and Human Services, HHS. It wasn't a press release, it was a 412-page actuarial adjustment, specifically Document 42-CFR-Part-422. This wasn't a routine update, it was the mathematical signature of a systemic liquidation. On October 14th, the internal data points hit a threshold we call the zero inertia point. For decades, the American middle class has been told a specific story, that the Great Wealth Transfer, a $68.4 trillion migration of assets from the silent generation and baby boomers to millennials, would be the greatest economic windfall in human history. It was framed as the ultimate safety net, a correction for a generation priced out of housing and burdened by student debt. But the math inside the HHS filing tells a different story. It reveals that the exit ramp for this wealth has already been built and the toll booths are owned by private equity. We are tracking a specific anomaly in the 2026 fiscal projections. The cost of high acuity memory care in the top 15 U.S. metropolitan areas has spiked to a median of $14,200 per month. That is $170,400 per year. For a 5-year end-of-life cycle, that represents an $852,000 extraction. In a country where the median home value in those same areas is $780,000 and the average 401k balance for a 75-year-old is $142,000, the result is a perfect zero-sum liquidation. The Great Wealth Transfer isn't a transfer to the next generation. It is a targeted arbitrage of the American inheritance. By the time the probate courts are finished in 2026, there will be nothing left but the debt. The last harvest has begun. To understand why this is happening, we must first look at the narrative the masses are being fed. If you open any mainstream financial publication today, you will find the same optimistic projection. They call it the golden era of inheritance. The narrative is simple. The baby boomer generation and the wealthiest generation in history is reaching the end of its life cycle. They own the homes, the blue chip stocks, and the retirement accounts. As they pass, this capital will flood into the hands of 72 million millennials. The mainstream media presents this as an inevitability. They show charts of rising real estate values and the compounding growth of the S&P 500 since the 1980s. They tell you that the inheritance economy will solve the housing crisis, pay off the $1.7 trillion student loan bubble, and fuel a new era of consumer spending. Consider the statements from the Federal Reserve's Survey of Consumer Finances. They highlight that households headed by someone 65 or older hold a combined net worth of over $70 trillion. The media takes this number, divides it by the number of heirs, and arrives at a figure of roughly $1 million per person. It is a seductive lie. It lulls the middle class into a false sense of security, encouraging them to continue taking on debt today because the money is coming tomorrow. Even the financial planning industry is built on this visible story. Advisors talk about tax-efficient transfers, step-up in basis, and estate planning. They operate under the assumption that the assets currently on the balance sheet will still be there in 10 years. They ignore the predatory evolution of the cost of living, specifically the cost of staying alive. What the visible story fails to mention is that the $68 trillion figure is a gross number, not a net number. It doesn't account for the death arbitrage being engineered behind the scenes. It assumes the current regulatory environment for Medicare, Medicaid, and private long-term care insurance will remain static. It ignores the reality of the spend-down requirement. In the United States, if you want the government to help pay for your end-of-life care, you must first become destitute. You must spend down your assets to roughly $2,000 in most states. This isn't a secret, but the speed and efficiency with which the private sector is now facilitating this spend down has reached a systemic level. The media focuses on the size of the pie. The hidden hand is focusing on the drain. The public is watching the front door for a delivery of wealth, while the back door has been removed entirely and the furniture is being loaded into a truck labeled Healthcare Administration. The mechanism for this asset extraction is not a single law or a single company. It is a multi-layered asset vacuum engineered through the convergence of private equity and the administrative state, and we call this the silver tsunami arbitrage. In 2026, we are entering the peak of the demographic curve. Every day, 10,000 Americans turn 65, but the critical number is 85, the age at which professional care becomes a statistical certainty for over 50% of the population. This is the capture zone. Step 1. The consolidation of the care grid. Over the last 72 months, we have observed an unprecedented M&A wave in the long-term care LTC sector. Giant private equity firms, Blackstone, KKR, and specialized REITs like Welltower, WELL, have been quietly acquiring the care grid. They aren't just buying nursing homes, they are buying the entire vertical stack, the physical real estate, the management companies, the hospice services, and the pharmacy benefit managers, PBMs. When a private equity firm buys a nursing home, they perform a sale-leaseback transaction. They sell the building to their own internal real estate investment trust, REIT, and then charge the nursing home an exorbitant rent. This artificially lowers the profitability of the nursing home on paper, allowing them to lobby for higher Medicare reimbursements while simultaneously siphoning the cash flow out of the facility and into the offshore REIT. This is the technical physics of the fraud. The costs stay with the facility and the patient, while the profits are moved into the capital markets. Step 2. The Medicaid Look-Back Trap. The system is designed to catch anyone who tries to protect their wealth. Under Section 1917 of the Social Security Act, the government enforces a 5-year look-back period. If you transfer your house to your children today and need nursing care 4 years and 11 months from now, the government will undo that transfer or disqualify you from aid until you pay a penalty equal to the value of the house. The hidden mechanism in 2026 is the integration of AI-driven asset tracing software within the Centers for Medicare and Medicaid Services, CMS. This isn't your grandfather's audit. This is a real-time high-frequency scan of every property deed, bank transfer, and brokerage movement. The 5-year window is now a digital prison. The system knows the exact moment your parents' net worth crosses the spend-down threshold. Step 3. The arbitrage of the 401k. Traditional retirement accounts, 401ks, IRAs, are the primary target. Because these assets are liquid and taxed upon withdrawal, they are the first to be consumed. The hidden mechanism uses managed care protocols to ensure that the withdrawal rate from these accounts matches the maximum allowable medical expense. In the 1990s, the average stay in a nursing facility was 3 years. Today, due to advancements in pharmacology and maintenance medicine, we can keep a biologically failing body alive for 7 to 10 years. This isn't about longevity, it's about revenue cycle management. Every additional year of stability is another $150,000 extracted from the family's legacy. We are witnessing the conversion of biological life into EBDA, earnings before interest, taxes, depreciation, and amortization. Step 4, the captive insurance loophole. The largest care providers have created captive insurance subsidiaries. They force the elderly residents to buy supplemental insurance that is essentially a self-dealing mechanism. So then the resident pays premiums into a company owned by the facility's parent corporation. When a claim is made, it is denied or delayed through prior authorization algorithms. The money never leaves the corporate ecosystem. It is a closed loop designed to maximize capture rate. Step 5, the ERISA preemption. A critical technical detail that 99% of people miss is the use of ERISA, Employee Retirement Income Security Act, preemption. Large-scale corporate care providers use ERISA to shield themselves from state-level malpractice and consumer protection laws. If the facility provides negligent care that hastens the depletion of assets, the family's ability to sue is severely limited by federal law. The physics of the risk are weighted entirely against the individual. The hidden hand here is the institutional investor. They realize that death and taxes are the only two certainties in life, so they decided to own both. The $68 trillion wealth transfer is being intercepted midair. It's an asset swap. The boomers get a semi-private room with a generic IV drip, and the private equity funds get the title to the family home and the remaining balance of the Vanguard Admiral shares. This is not a conspiracy, it is a structural necessity for a system with $34 trillion in national debt and an unfunded liability for Social Security and Medicare exceeding $175 trillion. The government needs this wealth to be spent on care so that it doesn't have to print the money itself. The last harvest is how the system settles its own books. How does the system protect this extraction mechanism from being disrupted? It creates liquidity levers and accounting illusions that make the collapse look like a solution. The primary tool for the system's fight back in 2026 is the expansion of Medicare Advantage, Part C. On the surface, Medicare Advantage is marketed as a choice for seniors, lower premiums, vision, and dental coverage. In reality, it is a privatization of the denial process. By moving seniors from traditional Medicare to private Advantage plans, the government shifts the risk pool to private insurers like United Healthcare and Humana. These insurers are then paid a flat fee per patient by the government. Their profit is the difference between the government payment and what they spend on care. This creates a massive incentive to deny care. In 2026, we are seeing the deployment of denial by default algorithms. If a boomer needs a $50,000 heart valve or a $10,000 a month Alzheimer's drug, the algorithm denies it. The family is then forced to pay out of pocket to save their loved one, which accelerates the spend down of the inheritance. The solution to the rising cost of healthcare is actually a mechanism to force the private liquidation of family assets. The historical anchor, 1971, and the 2008 echo. In 1971, Nixon took the world off the gold standard, decoupling currency from physical reality. And in 2008, the Fed decoupled risk from consequence through the great financial crisis bailouts. In 2026, the system is decoupling inheritance from family. Compare this to the 1980s savings and loan crisis. Back then, the system patched the cracks by consolidating smaller banks into too-big-to-fail institutions. Today, the system is patching the Medicare insolvency by consolidating family wealth into too-big-to-fail healthcare monopolies. The patch is the Estate Recovery Program, under Federal Law 42 U.S.C. Section 1396P, states are required to seek recovery from the estates of deceased Medicaid recipients for the costs of their care. Most people think their home is safe once they die. It isn't. The state becomes a primary creditor, often sitting ahead of the children in the hierarchy of payment. In 2026, estate recovery has become a high-tech, automated industry. The system is also using accounting changes to hide the fragility. The Financial Accounting Standards Board, FASB, has updated rules regarding how medical debt is reported and securitized. Just as the banks bundled subprime mortgages into CDOs in 2007, the healthcare industry is now bundling unsecured medical debt and future estate recoveries into new financial instruments. They are literally betting on how fast your parents will die and how much their house will sell for. These medical debt bonds are being bought by the same pension funds that are supposed to be protecting the workers' futures. It is a cannibalistic cycle. The pension fund invests in the debt of its own retirees' medical bills. The exit strategy this time is different. In 2008, they printed money to save the banks. In 2026, they are liquidating assets to save the social contract. They cannot print more houses. They cannot print more care, so they must reallocate what already exists. The fight back is a controlled demolition of the middle-class legacy to prevent a total sovereign debt collapse. By the time the public realizes that Medicare Advantage was a trap and estate recovery is a seizure, the assets will have already been digitized, securitized, and moved into the balance sheets of the top 0.1%. The system doesn't want to fix the problem, it wants to own the problem's resolution. When does the illusion shatter? Our models point to Q3 2026. The breaking point will not be a sudden stock market crash. It will be the insolvency of the Advantage plans. In mid-2026, we expect the publication of internal audit reports from the major Medicare Advantage providers showing a catastrophic loss ratio. The cost of care for the oldest old, those 85 plus, will finally exceed the government's ability to subsidize it. When this happens, the insurers will do what they always do. They will reprice. Premiums for supplemental care will double overnight. Co-pays for long-term care will shift from 20% to 50%. This will create a forced liquidation event. Millions of families who thought they were covered will receive letters stating that their daily care benefit has been capped at $150, while the actual cost is $450. At that moment, the great wealth transfer becomes a great wealth evaporation. The breaking point is the day the average American family has to choose between their child's college fund and their parents' oxygen tank. The system has bet that people will always choose the latter, and that choice is the capture point for the remaining $68 trillion. Analytical positioning: how the smart money is moving. This is not financial advice. This is an analysis of how the predatory class is positioning itself to avoid its own trap. There are three primary strategies being deployed by high net worth individuals to survive the silver tsunami arbitrage. 1. The Irrevocable Asset Protection Trust, IAPT. Smart money does not own assets, they control them. The 5-year look-back period is only a threat if you start too late. We are seeing a 400% increase in the formation of irrevocable trusts among the upper middle class, $2 million to $10 million net worth. By transferring the title of the home and the brokerage accounts into an IAPT 5 to 7 years before the care is needed, they effectively divorce themselves from their wealth for Medicaid purposes. The wealth remains in the family, controlled by the heirs as trustees, while the parent appears destitute on paper. 2. Non-correlated, invisible assets. The asset vacuum relies on the digital trail of deeds and bank accounts. Smart money is shifting a portion of their legacy into assets that are difficult to seize or trace via automated CMS algorithms. This includes physical precious metals held outside the banking system, private lending contracts within family members, properly papered to look like debt, and jurisdictional arbitrage. 3. Jurisdictional arbitrage. Not all states are created equal. Some states, like Florida and Texas, have strong homestead protections that make it harder, though not impossible, for Medicaid estate recovery to take the primary residence. However, the most sophisticated actors are looking at international long-term care. The cost of world-class 24/7 nursing care in jurisdictions like Panama, Portugal, or Thailand is 70% lower than in the US. By moving the person rather than just the money, they preserve 70% of the inheritance. The breaking point in 2026 will be a moment of clarity. You will either be a source of yield for a private equity fund, or you will be untraceable. The middle class is being funneled into the yield category. The last harvest is designed for those who followed the rules, paid into the system, and believed the visible story. The positioning requires a cold open of your own. You must accept that the social contract regarding elder care is null and void. The math has changed. The $68 trillion is not yours. It is unclaimed property in the eyes of the system, and they are coming to claim it. The data leads us to 4 cold structural truths. The inheritance is a liability. The $68 trillion great wealth transfer is the primary funding source for the insolvent U.S. healthcare system. Your parents' assets have already been priced into the recovery models of the 2030s, and the care grid is a vacuum. Private equity consolidation has turned end-of-life care into a sale-leaseback of the American dream. The goal is to ensure the final bank balance of every boomer is exactly $0. Medicare Advantage is the kill switch. Privatized denial of care is the tool used to force families to liquidate their private savings to cover the shortfall. Geography is protection. If you stay within the standard U.S. administrative grid, your family's legacy will be harvested. Survival requires early trust formation or jurisdictional exit. The silver tsunami isn't a demographic crisis, it's an arbitrage opportunity. The system isn't breaking, it's working exactly as intended to liquidate the last remaining pocket of private middle-class wealth. The most expensive thing you can own in 2026 is a guaranteed promise from the government. Plan accordingly.